Welcome back to the deep dive. You know, some topics are intimidating purely because of the sheer volume and complexity of information surrounding them.
Oh, absolutely.
The 2008 financial crisis is absolutely one of those. It's a dense forest of complex acronyms, institutional failures, and all these conflicting narratives about who really holds the ultimate responsibility.
Right.
It often feels overwhelming just to get a handle on the foundational mechanics.
It does. And I think the result is that a lot of people either avoid the topic entirely or they feel, they need to read a 1,000-page history book just to figure out what a collateralized debt obligation even is.
Exactly.
Our mission today is to cut through that complexity using the source material you've provided. We're going to connect the dots.
Okay.
We'll go from central bank policy, which really provided the fuel, to the specific toxic assets that were created, which was the ignition, and then to the eventual systemic failure of these financial giants.
And we're going to look at just how close the whole system came to a complete collapse, right?
Terrifyingly close. And then we'll examine what followed. The lasting systemic shifts in the world of regulation and, frankly, in financial power itself.
Exactly. This deep dive is about shining a spotlight on the precise architecture of that crisis. We're looking at the fundamental policy mistakes that allowed the bubble to form in the first place.
The foundation.
Then the specific anatomy of those toxic assets. We're talking subprime and Alt-A loans and how they were packaged up.
The weapons of financial mass destruction, as they were called.
Right. And then the immediate market panic when the dominoes started to fall, and of course the lasting legacy. The power dynamics, the enforcement, or maybe the lack of enforcement between Washington and Wall Street.
In essence, we're giving you, the listener, the ability to understand not just what you saw on the news screens back in 2008, but why it happened.
Yes.
Starting with the very foundation of the crisis. The mistakes made by the powerful institutions that were tasked with keeping the system stable. And specifically, we have to start with the Federal Reserve.
Okay, let's unpack this, and we have to start at the top. I think we need to go upstream of all the reckless lending.
That's the right way to look at it.
So many people jump straight to the bad mortgages, but that's the fire. We need to talk about the oxygen supply first. We have to begin with monetary policy. Our sources state pretty unequivocally that, according to many leading economists and senior officials today, the Federal Reserve itself was truly at the eye of the storm leading up to 2008. It created the very environment where this bubble could thrive.
That's a crucial point, and is why understanding the sequence of events really matters. The widespread consensus view now is that the crucial initial error that set the entire housing market on fire was rooted in the Fed's decision to keep interest rates too low for too long.
Too low for too long. We hear that phrase a lot. What does it mean in practical terms?
Well, specifically, after the dot-com bust and then 9/11,
Right.
The Fed was trying to stimulate the economy. So they dropped the Fed funds rate dramatically, and they held it at just 1% for a significant period between 2003 and 2004.
Just 1%. That's practically free money.
It is. And what's particularly striking and, frankly scandalous, is that sources describe this error not as some unpredictable once-in-a-century event, but as textbook knowledge.
So this wasn't just hindsight.
Not at all. People were warning about it at the time. The textbook says that when you hold rates that low for that long, you are inevitably going to create a speculative boom somewhere in the economy.
And given all that cheap credit, housing was just the natural destination.
It was the natural destination. A bust was highly likely to follow. It was a known risk that was, either consciously accepted or just ignored.
That's the key structural flaw then. The money was incredibly cheap.
Precisely. When capital is priced that low, it flows easily and abundantly into higher risk, higher return areas. It's just searching for yield.
And the housing market became that area?
The direct result of that prolonged low interest rate environment was the massive inflation of the housing bubble. It's what allowed home prices to completely detach from underlying rental incomes and, any kind of historical norm.
But the Fed's failure wasn't just about the interest rate setting, was it?
No, it was a dual failure. It stemmed from a prevailing philosophical error at the time.
You're talking about the context of the Great Moderation, aren't you? That period where policymakers were convinced they had economic cycles completely tamed?
Precisely. The Great Moderation was the philosophical backdrop of that whole era. The belief, which was widely held in the mid-2000s, that thanks to clever central banking and globalization, that inflation and economic volatility had been permanently conquered.
A bit of hubris then?
A huge amount of hubris. It led to a huge amount of confidence in the Fed's capabilities, but also, and this is the critical part, an over-reliance on markets to self-regulate.
And we know that the Fed chairman at the time, Alan Greenspan, was a known advocate for free markets. He deeply mistrusted government interference.
He did.
So how did that ideology practically impact the Fed's regulatory responsibilities?
Well, it led to paralysis on the regulatory side. The sources are absolutely clear on this. The Fed failed not only to prevent the formation of the housing bubble, but it also failed to prevent the predatory lending scandal.
It just wasn't watching.
It utterly failed to regulate the most important part of our financial system, the mortgage and shadow banking sectors, even though it had the tools and it had the power to do so.
So the institution failed on its two primary responsibilities leading up to the crisis: setting interest rates appropriately and regulating lending practices.
Yes.
So it wasn't just an operational mistake, it was a philosophical one. It was letting a textbook bubble form because of an over-reliance on the market regulating itself, an ideology that just proved catastrophic.
Absolutely catastrophic. And you have to think about the costs. The cost of this philosophical inaction was immense. It laid all the tinder for the explosion.
And people at the Fed now admit this.
Oh yes. Those who worked at the Fed, including some who were senior officials at the time, now recognize that big mistakes were made. We often talk about the risk being created, but in the financial world, risk itself is the essential commodity. It's a product that can be traded.
Right.
In this case, the risk wasn't just created naturally. It was subsidized and amplified by policy decisions that flooded the system with cheap money while simultaneously removing any meaningful regulatory oversight.
That creates a really perverse incentive structure right from the start.
It does.
I mean, if I'm a lender and I know money is virtually free and the regulator isn't watching me, why wouldn't I pursue the riskiest, highest yield loans I possibly can?
There's no reason not to.
It's a perfect storm of cheap money meeting lax oversight and this kind of ideological certainty.
And that cheap money didn't just stay in traditional bank accounts. It sought out these complex structures where it could generate much higher returns, which leads us directly into the complicated world of structured finance.
Right.
And the instruments that were created to capitalize on this housing boom.
Okay, let's hold that thought about perverse incentives, because we absolutely need to see where that cheap money flowed. Now that we understand the policy foundation, this ocean of cheap money, let's unpack the specific assets that took advantage of that environment.
The toxic assets.
The risky mortgage products that were packaged up and sold across the globe, eventually mutating into these incredibly complex securities like collateralized debt obligations or CDOs.
And we need to define the terms clearly because toxic assets just gets used as this generic bogeyman.
Right.
At the core of the failure were two main types of loans: subprime and Alt-A. Most people have heard of subprime. These were loans given to borrowers with poor credit histories, low scores, and a high probability of default.
The riskiest of the risky.
Pretty much. But Alt-A loans, or Alternative A, are in some ways far more revealing about the total lack of diligence in the system.
What defined those Alta loans specifically? What made them different?
They were characterized as mortgages provided to borrowers with unstated or crucially unverified income levels.
So you just took their word for it?
Essentially, yes. They were the loans where the borrower might check a box, saying they earned six figures, but the lender did absolutely zero due diligence to verify that claim. They became colloquially known as liar loans.
Liar loans, wow.
They fell into this gray area, maybe better quality than pure subprime, because sometimes the borrower had good credit or significant assets, but they were far riskier than traditional prime mortgages, because the income stream that was supposed to be underwriting the loan was a complete unknown.
And the true toxicity wasn't just the individual loans themselves, but what happened next? Securitization. Can you explain to the listener just simply how these Alt-A and subprime mortgages turned into these weapons of financial mass destruction, specifically through CDOs?
It's the packaging process that's the key. A bank like Countrywide, for example, would originate thousands of these risky mortgages. Then they would pool them all together.
Okay.
That pool was then sold off to an intermediary, which would create a mortgage-backed security, or MBS.
So far, so good.
Then, and this is the crucial step, these MBSs, often containing a mix of prime, Alt-A, and subprime loans, would be chopped up again and put into an even more complex structure called a collateralized debt obligation, a CDO.
So they were taking one risky asset and using it as the ingredient for an even more complicated, even more opaque product.
Exactly. And the magic, or the trick, was how the CDO was structured. It was divided into slices or tranches with different levels of risk.
So not all slices were equal.
Not at all. The top slice, the senior tranche, was paid first from the mortgage payments coming in, and it was supposedly the safest. The ratings agencies rated it AAA rock solid.
And the bottom slice.
The bottom slice, the equity tranche, was the riskiest. It got paid last, so it absorbed the first losses if borrowers defaulted, but it also offered the highest potential return.
And the assumption, which was sold aggressively by Wall Street and blessed by the ratings agencies, was that defaults would only happen at the bottom, right?
Yes, the thinking was that the AAA slice was virtually untouchable, safe as a treasury bond.
But that assumption was critically flawed because of the way Alt-A and subprime loans behaved during a downturn.
It was fatally flawed. The entire model relied on one fundamental assumption: that housing prices would never fall nationwide simultaneously.
An assumption that had held true for decades.
It had. And as long as prices kept rising, even if someone defaulted on their liar loan, the bank could just seize the house and sell it for a profit. So the CDO didn't suffer a loss.
But then prices stopped rising.
And then they started falling. And when they started falling nationwide, the default correlations, the likelihood that all these various Alt-A and subprime loans would fail at the same time, shot through the roof.
So the risk wasn't contained in that bottom tranche anymore.
No. It poisoned the entire capital structure of the CDO, including those safe AAA slices that were held by pension funds and global banks all around the world.
And that is the pivotal systemic failure. Because these risky loans didn't just stay in the hands of the initial lenders.
Not for a minute.
They were rapidly securitized and absorbed by major government-sponsored entities, Fannie Mae and Freddie Mac.
Yes, and our sources highlight that these entities continued to purchase and securitize subprime and Alt-A mortgage-backed securities from 2005 all the way through 2008.
And that is the mechanism by which the risk became truly systemic and global, isn't it?
It's the amplifier. Fannie and Freddie were perceived by the market as inherently safe because they carried an implied government backing. Everyone assumed the government would never let them fail.
So they were basically vacuuming up these risky assets.
They were, and packaging them into securities that were then sold around the world. Foreign banks, pension funds, other institutions, they all bought them because they were stamped with a government guarantee, or at least the implicit face in one. They essentially acted as a massive global amplifier for the poison.
Now, we have to address the regulatory context here, specifically the role of the Community Reinvestment Act, or CRA, because the source material mentions that Fannie and Freddie had to offset their purchase of these Alt-A securities with more mortgages for low and moderate income borrowers to meet affordability goals. And this often gets spun politically as the core cause of the whole crisis.
That context is vital, and this is where we need to look at the specific data nuggets provided in your material to separate the political spin from the reality.
Okay.
While there was certainly pressure on these entities to meet specific affordability goals, the vast majority of the most toxic, highest-risk lending was not driven by the CRA mandates.
Give us the specifics on that data. What does the evidence actually show?
The specific detail in the sources reveals that only 6% of the higher-priced loans, meaning the riskier loans characterized by high interest rates, many of which were Alt-A, were actually extended by CRA-covered lenders to lower-income borrowers or neighborhoods within their specific assessment areas.
Only 6%. 6%. That figure is damning because it shows that while the CRA created a regulatory environment that encouraged some low-income lending, the overwhelming majority, 94% of the reckless, high-risk mortgage market was happening outside of these narrow parameters.
That dramatically shifts the narrative. It suggests that it wasn't simply a policy designed to help low-income borrowers that was the main driver of the bubble.
Not even close.
It was a widespread, profit-driven race for yield across the entire financial industry, combined with institutions that were, yes, trying to meet their quotas, but they were doing it regardless of the ultimate quality of the underlying loans.
Exactly. The systemic failure was much broader and much more profit-driven than it was politically motivated. It was greed, amplified by cheap money, and hidden by the complexity of securitization.
And the tragedy is that the crisis just kept growing despite clear, visible problems. Which brings us to the early warning signals that were systematically ignored. Yes, and we have the concrete example of Countrywide, which was a huge player in the mortgage origination market. In July of 2007, they released their operational results.
A year before the Lehman collapse, what did that report communicate to the world?
It clearly showed that foreclosures and delinquencies were increasing dramatically within their portfolio. This was not hidden data, it was out there. This specific data showing deterioration was publicly available to investors, to regulators, to everyone.
And yet, the market kept going.
Many market participants, including high-level firms, were repeatedly surprised by the depth and the duration of the deterioration of these markets, even after these warning signs had been posted.
So why the surprise? If the data was public, why was there this collective cognitive failure?
Because the complexity of the CDO structure obscured the actual risk. Once a loan was pooled and sold into a CDO, the originator no longer cared about its quality.
They got their fee and moved on.
Right. And the buyer, maybe a pension fund in Germany, only looked at the AAA rating stamp, not the underlying liar loan delinquency rate in California.
The whole financial ecosystem had become so reliant on the idea that housing prices would never go down across the board.
That they simply dismissed concrete evidence that the raw ingredients, the Alt-A mortgages, were deteriorating rapidly. It's the classic boom mentality. You assume perpetual profit, even when the underlying fundamentals are screaming at you otherwise.
It sounds like they traded a highly complicated, sophisticated financial product without adhering to the very basics of analysis, which is, what your sources advise investors to always be crystal clear about. You have to understand the raw underlying risk.
And they'd completely lost sight of it.
Okay, we've tracked the chain. Low rates created the fuel. Alt-A and subprime loans packaged into these risky CDOs created the tinder, and the ignored warnings set the stage. Here's where it gets really interesting and, frankly, terrifying.
This is where it goes from theory to reality.
We transition from theoretical risk to catastrophic reality for Wall Street. The system needed a pinprick to realize the interconnected toxicity, and that came in the form of cascading institutional failures.
And we can't just jump straight to Lehman without acknowledging the critical tension that preceded it. The entire year leading up to September 2008 was a sequence of escalating near-death experiences for the financial system.
You're talking about Bear Stearns.
Exactly. The first major panic signal was the failure of Bear Stearns in March of 2008.
Bear Stearns, a major investment bank, essentially failed over a weekend. The Fed had to intervene and organize a fire sale to JP Morgan Chase, which prevented a potential disaster.
That intervention was absolutely crucial because it signaled to the market that the government would not allow a major firm to fail if the systemic risks were deemed too high.
It set a precedent.
It established an expectation. However, this intervention also created immense confusion just 6 months later when the Treasury and the Fed decided to draw a line in the sand with Lehman Brothers.
So let's focus on Lehman then. Introduce it not just as another firm, but as a pillar of the system.
Lehman Brothers was Wall Street's oldest investment bank. It was a major counterparty across the globe. Its eventual collapse wasn't just a sign of failure. It was the mechanism by which the global financial system seized up entirely.
Why? What was the realization?
The realization hit that if Lehman could fail, any counterparty could fail. No one was safe.
And the numbers leading up to that final weekend were just stunning. They showcased just how much bad risk Lehman was holding. Can you detail the financial figures they announced right before the collapse?
In the days leading up to its eventual filing for bankruptcy on September 15th, Lehman announced a colossal $3.9 billion third quarter loss.
$3.9 billion.
And included in that loss was a staggering $5.6 billion write-down. That write-down signaled that the firm's assets, many of them, those very mortgage-backed securities and CDOs we've been talking about, were severely impaired, far more than anyone had publicly assumed or had hedged against.
I just want the listener to stop and visualize that. $5.6 billion in reported asset value simply evaporating overnight.
It's a shocking number.
That announcement must have instantly shattered confidence, because it exposed the true depth of the losses that were hidden in these structured finance products across the entire system.
And confidence is the lifeblood of finance. Without it, everything stops. The immediate response from the larger financial ecosystem was a full-blown freeze.
Where did that freeze happen first?
Specifically in the crucial short-term lending market known as the commercial paper market. This is where big companies borrow money for their daily operations, for payroll, for inventory. Once Lehman collapsed, no firm trusted any other firm to pay back even an overnight loan.
The panic was immediate and almost automated. We see this documented clearly in the source material. Matthew Rutherford, an advisor to the Treasury, immediately emailed his colleagues that several large money funds had reduced their exposure to Lehman.
They were pulling their cash out instantaneously.
Just hit and sell.
That rapid reduction in exposure, known as de-risking, was the signal that a full-blown market panic was underway. And the sources confirmed the severity of that moment. Fidelity, the largest fund complex in the world, stressed that while they hadn't made any significant shifts yet at that moment, They were actively in the process of making decisions on reducing their exposure.
And when money market funds, which are supposed to be the bedrock of corporate liquidity, start pulling back from major institutions,
The liquidity for that institution, and potentially the entire system, evaporates overnight. It's a self-fulfilling prophecy of failure.
it's a classic example of how trust is the ultimate non-physical asset in finance.
Absolutely.
And when that trust evaporates in a major counterparty, the market reacts ruthlessly and automatically. We see that automated reaction constantly in markets today. For instance, in modern stock exchanges, where member brokers trade through these networked computer systems.
High-frequency trading.
Right. But here, the automation was the instantaneous global realization that the counterparty risk, the risk that the firm you lent money to just wouldn't be there tomorrow to pay you back, was suddenly too high to bear.
And what's fascinating here is that the sources immediately put the 2008 event into a much larger historical context. They compare the fundamental scale of the crisis to the 1929 Great Depression.
Wow.
That's an assessment of the fundamental scale of the economic destruction that was potentially being unleashed.
That is a terrifying comparison. But there was a crucial difference that kept 2008 from becoming Great Depression 2.0.
Yes. The policy interventions, the unprecedented bailouts of AIG, the TARP program, the government guarantees, they were all aimed specifically at preventing what happened after 1929.
Which was what, exactly?
The full-blown banking panic and the subsequent debt deflation that ensued. And we should probably clarify what debt deflation means because it's the absolute horror they were trying to avoid.
Yes, let's unpack that concept for the listener.
Debt deflation is a vicious economic spiral. When the crisis hits, asset values like housing or stocks fall sharply. This forces debtors, individuals, companies, or banks, to sell assets at fire sale prices just to cover their debts.
Which just pushes prices down even further.
Exactly, which leads to more forced sales, which depresses prices more, and on and on. This leads to a massive reduction in spending and investment across the entire economy. It's a death spiral.
So the difference in 2008 was that the interventions stopped that spiral.
The systemic interventions avoided that continuous spiral of asset values falling and banks seizing up entirely. They prevented the complete collapse of confidence and the resulting deflationary environment that defined the 1930s.
It sounds like the policymakers, having completely ignored the textbook warning signs of a bubble, finally heeded the history of 1929.
They did.
And they realized immediate massive intervention was necessary to prevent total systemic collapse, even if those interventions were massively unpopular politically.
They understood, perhaps too late, that a lack of historical knowledge is often what causes the most damage. I mean, think of the principles of long-term capital management back in 1998. Their ignorance of the vagaries of financial history almost single-handedly brought the Western financial system to its knees a decade earlier.
And 2008 was the larger global echo of that same near-death experience.
Triggered by the same kind of highly leveraged, complex risk-taking in financial products, nobody fully understood.
So what does this all mean for the structure of finance moving forward? The crisis exposed not just bad lending, but these fundamental imbalances of power and priorities. Let's look at the structural consequences, particularly in regulation and the enduring relationship between Wall Street and Washington.
This crisis really accelerated and exposed a long-term trend that had been ongoing since the 1970s.
Which was
the increasing significance of American finance in the overall American economic system. It led to a demonstrable transfer of political power, of influence, and importantly, of expertise from Washington, D.C. to Wall Street. As finance grew, its political clout just became undeniable.
the cynical idea that Goldman Sachs rules the world, as one source puts it, really captures this transfer of influence.
It does.
And this power imbalance leads directly to what you might call the impunity problem, the sense that the biggest players can take the biggest risks without facing any genuine personal consequences when those risks blow up the system.
That is the core issue post-crisis that drove immense public anger. The cynical view suggests that the system constantly encourages untrustworthy behavior because it never really enforces a punishment against the individuals responsible.
So you get impunity for thieving bankers, which just incentivizes more problematic behavior down the line.
Of course. If the consequences of massive system-threatening risk-taking are absorbed by the taxpayer and the public, but the massive profits remain private, the incentive structure is permanently skewed toward excess.
And we can't talk about this power imbalance without mentioning the firms that actually thrived, the ones that allegedly contributed to the disaster and then benefited from the ensuing chaos.
Right.
Goldman Sachs is the prime example cited in the sources, a firm that grew richer during the crisis. A crisis, it is alleged, they helped create by selling these complex, toxic CDOs to their clients while simultaneously betting against them.
The firm faced very serious allegations of manipulating world trade prices and betraying clients by selling products they knew were designed to fail. It serves as this powerful illustration of that persistent power imbalance.
And no senior executives went to prison.
No. When high finance can operate with this level of alleged impunity, with firms paying large fines, but no individuals facing real consequences, it fundamentally changes the nature of the economic game. Why would you stop the risky behavior if the upside is unlimited profit and the downside is a taxpayer-funded safety net?
So after the dust settled and the political will finally coalesced, regulators had to act. One huge area of focus was this obscure market that housed so much of the systemic risk and the invisible counterparty connections. The derivatives market.
The danger posed by the over-the-counter, or OTC, derivatives market was just enormous.
Why was it so dangerous?
Because it operated largely outside of regulated exchanges. It was all bilateral, private deals between two parties, often completely invisible to regulators and the public. This made the counterparty risk invisible and incredibly interconnected.
Which is precisely how AIG nearly brought down the entire system.
Exactly, through its failure to meet its obligations on credit default swaps, or CDS, which is a type of derivative. So re-regulation was absolutely essential.
So how did the international community attempt to mitigate this risk in the derivatives market post-2008?
The key approach that was internationally agreed upon was mandatory central counterparty, or CCP, clearing for standardized OTC derivatives.
And what does a CCP do?
A CCP acts as the buyer to every seller and the seller to every buyer. If you trade a standardized derivative, you are now trading with the CCP, not directly with your counterparty.
So it centralizes the risk.
It does. And this mandate was necessary precisely because derivatives traders lacked any adequate incentive to voluntarily enter into central clearing. Without that regulatory push, the risk would simply migrate back into the shadow markets, and all that transparency would vanish again.
That seems like a logical, necessary step forcing risk transparency and having clearinghouses to absorb the immediate failure of a single firm.
It is.
But new rules, especially those written in a crisis atmosphere, often have profound unintended consequences. And that brings us to the thorny issue of moral hazard and the Dodd-Frank Act.
This is a deep and often missed nuance when we talk about post-crisis reform. The intent of the new rules, particularly the provisions in the Dodd-Frank Act, was to prevent future targeted bailouts of single institutions, like what happened with Bear Stearns or AIG.
Right, no more picking winners and losers.
Exactly. However, the requirement under Dodd-Frank that emergency Federal Reserve lending must be conducted through programs with broad-based eligibility has complex and potentially worsening implications for moral hazard.
Okay, moral hazard, for the listener, is the idea that protection against risk actually encourages taking on more risk. So how does broad-based eligibility make punishing bad behavior harder? Let's use that auto loan market example from the source material to illustrate this carefully.
Okay, let's imagine a situation 5 years after the crisis where the auto loan market starts to seize up. You have two major companies originating auto loans, Company A and Company B. Company A has made wildly high-risk investments, their assets have gone bad, and they are insolvent. They are a bad manager of risk. Company B, on the other hand, is well-managed, solvent, financially sound, but they're facing a temporary liquidity issue because the entire market is nervous about all auto loan originators due to Company A's mismanagement.
So if the Fed could intervene surgically, they would ideally lend only to Company B to keep the solvent firm running and prevent a panic while letting Company A fail.
Right, you punish Company A's managers and shareholders for their failure.
That would be the ideal punishment structure to reduce moral hazard.
It would. But under the new Dodd-Frank provisions, the Federal Reserve is unable to extend credit only to the good actor, Company B, while letting the bad actor, Company A, fail.
And why is that?
Because the lending must be offered to both companies A and B under this requirement of broad-based eligibility. The program cannot be designed to target only one healthy firm.
So you're saying that the well-managed Company B can't receive essential temporary aid without the poorly managed insolvent Company A getting access to the exact same resources?
That is correct. In doing this, the new provisions that were designed to prevent targeted bailouts make it inherently more difficult for the system to isolate and punish Company A's mismanagement and shareholders without also punishing its stakeholders, employees, suppliers, you name it, in the solvent Company B.
So the new rules effectively force the Fed to prop up the entire sector.
rather than isolate the single failing institution.
Wow, that is the irony, isn't it? Forcing broad-based eligibility risks worsening moral hazard, because if Company A knows that if it fails, the entire market will get subsidized, it doesn't fear failure nearly as much.
It becomes a feature, not a bug.
It demonstrates the profound difficulty of designing regulations that deter the creation of risk without also harming innocent parties during a systemic crisis.
And that difficulty, the inability to truly punish failure on Wall Street without triggering a global catastrophe, is the lasting legacy of the crisis. It proved that planet finance had grown too complex and too interconnected to fail cleanly.
This deep dive has certainly clarified the precise chain of events for you, the listener. You have an environment of low interest rates contributing to a massive housing bubble, which was then amplified globally by the widespread securitization of risky Alt-A mortgages into these toxic CDOs. This led to catastrophic systemic failures like Lehman's, forcing regulators into this ongoing struggle to mitigate future risk without creating new moral hazards through rules like broad-based eligibility.
Right.
It's a dense, intricate, and honestly a deeply frustrating history.
It is. And the lasting lesson is perhaps about the fundamental nature of risk itself in the financial world. Risk is not just an inherent possibility of loss, it is a commodity.
It's a product.
It is a product that can be packaged, rated, sold, and traded for profit. And during times of market dislocation, times of disaster, like the seizure of the commercial paper markets move, and massive opportunities are seized by those who position themselves correctly.
That concept, never waste a disaster, it really resonates with the reaction we see from new generations of traders and ordinary citizens who witnessed the lack of accountability and correction after 2008.
Absolutely. The failure to truly correct the system after the 2008 crisis has fueled immense anti-Wall Street sentiment. You can see this manifest in powerful populist movements like the retail mania surrounding certain stocks.
The GameStop phenomenon.
Yes. The concerted attempt to beat planet finance with its own mechanisms, as one of our sources puts it. It's a populist uprising targeting the big short sellers, using the market's own leverage against itself. It speaks to a profound distrust of the entire financial structure that was established during the crisis era.
So, if history shows us the damage caused by ignoring historical knowledge, as the principles of long-term capital management did back in 1998, which almost brought the system to its knees,
A dress rehearsal in many ways.
how much closer did the 2008 crisis bring us to that edge, and what is the crucial difference for you, the individual investor, between an informed policy response and simply observing the next impending market dislocation? That's the question you need to consider as you navigate the modern financial landscape.